Good morning and welcome to Stefanutti Stock's financial results webcast for the year ended 29 February 2024. This presentation will be available on our website later today. It is with a deep sense of loss and great sadness that we received the news of Gino Stefanutti's passing on the 6th of May 2024. Gino founded the company in 1971. Gino was a remarkable man who led by example. I do not think he could ever have realized the extent of the incredible positive impact he had on so many lives, friends, colleagues, and even strangers. His legacy will forever remain in our culture and heritage, and we honor the memory of our founder, who inspired and motivated many within our organization and across the construction industry. Some of us fortunate enough to have worked closely with him will remember the many profound wisdoms and insights he shared. We bid Gino a final arrivederci. We will begin the presentation with our environmental social governance strategy, an update on the two Kusile power projects, followed by the operational overview. Yolanda will then present the financials, after which I will then discuss industry-related matters and close with our strategic objectives. There will be an opportunity for questions at the end of the presentation. Our environmental social governance ESG strategy is designed to manage the risks associated with ESG services through the use of effective practices and policies. The group has its own in-house digital platform to manage all ESG metrics. Our people are our real enablers, our biggest assets, and instrumental in our success. The group currently employs over 5,000 permanent employees and invested 16 million in skills development training, bursaries, and scholarships. Our in-house training academy, registered with the Mining Qualification Authority, allowing it to train and qualify operators and drivers. This academy has memorandums of understanding with CETA and MERCETA, allowing the group to provide all accredited construction-related training and apprenticeships. The group prides itself on its health and safety performance. Management and staff remain committed to our health and safety policies and procedures, and together strive to constantly improve the group's health and safety performances. The group ensures legal compliance on all projects and strives to exceed best practices. Continued investment in the safety management system delivered the desired outcome. There were 0 fatalities during the year. The group's lost time injury frequency rate of 0.03, an improvement when compared against a 0.05 for February 2023. The recordable case rate of 0.24, which is a significant decrease from last year's 0.44. The group is a ISO 45001-2018 certified. Quality in the group is driven via its digital platform to increase efficiency and productivity, decrease wastage, increase profit, and ensure consistent outcomes to meet client requirements, resulting in client retention and acquisition. To ensure the best possible client experience, client satisfaction surveys are conducted on all sites on a regular basis, where operations are rated against the following criteria: time, cost, quality, safety, health, environment, and general. The group has set an internal minimum benchmark of 80% for the survey and has achieved an overall average of 88% during the year. Where the internal minimum benchmark is not achieved, senior management engages with the client. The group is a ISO 9001-2015 certified. Stefanutti Stock's environmental management system is well established and was implemented in 2012. Our environmental policy is reviewed and revised on an annual basis, presenting the opportunity for participation and consultation of interested parties. Environmental objectives and targets are set annually. There were no significant environmental incidents nor legal transgressions during the year. Legal compliance and exceeding best practice remains at the forefront of all operations. The group is a ISO 14001-2015 certified. The group continues to be a level 1 broad-based Black economic empowerment contributor measured against the construction sector charter. The group acknowledges the value of enterprise development. Our strategy is to facilitate and maintain solid working relationships with capable Black-owned companies as either suppliers or subcontractors or both. Preferential procurement, suppliers and subcontractors are important stakeholders, and the group focuses on enhancing and developing these key relationships. The group has achieved the ISO 27001-2022 certification, and we are the first South African construction company to achieve this. The group has adopted Building Information Modeling Methodology, BIM. The strategic adoption provides unparalleled insight and foresight throughout operations, aiding real-time decision-making for all project stakeholders. We continue to enhance our in-house digital platform, which sets us apart in the market. This ongoing enhancement allows us to seamlessly align our organizational processes with our cutting-edge applications, providing us with a distinct competitive advantage. For example, the group has developed a real-time monitoring platform for our tailing dam facilities, which has revolutionized operations, allowing us to remotely measure critical parameters, ensuring proactive and safe management of these facilities. SSBR Joint Venture Package 16 Update. SSBR has finally commissioned the works during March 2024. The closing out of final snags and contract documentation is expected to be complete by the end of May 2024. The only items remaining to be concluded in the final measure are contract price adjustment, which we are currently reconciling and checking the calculations, and a large variation related to transport, which remains unresolved between ourselves and Eskom and will either be agreed or referred to the DAB as a separate dispute. The agreement of the final account is planned to be concluded during the third quarter 2024. It is anticipated that the outcome of this final account process will largely be in line with amounts previously received. All contractor claims giving rise to entitlement for extension of time plus costs, which occurred before 31st December 2019, are considered to be Claim 5. SSBR and Eskom continue to participate in the claims resolution process, which involves independent experts in support of the Dispute Adjudication Board, DAB, to evaluate the causes of delays and the quantification thereof. The claims resolution process provides for the issuance of interim decisions. These will then be consolidated into a single decision under Clause 20.4 of the contract, which will then be binding on the parties. As previously reported in September 2023, SSBR submitted its revised Claim 5 to the DAB, experts and Eskom to the value of 1.6 billion. The claim was based on the delay analysis as calculated by SSBR's delay expert and will be adjusted once the delay analysis is complete and agreed. Interest was not included in the claim and will only be calculated once the contractor's entitlement has been quantified. The original contract duration was 6 years with a completion date of November 2016 and a total planned construction duration of 19,000 days for the 77 sections. The Phase 1 and 2 delay analysis has been concluded as previously reported, with a total extension of time of 45,000 days for access and 25,000 days for construction delays. The experts are in the final process of concluding the Phase 3 delays with the DAB, which the DAB will be required to decide on during the second quarter of 2024. Following the conclusion of Phase 3 delay entitlements, a final delay expert report will be drafted by the experts and issued by the DAB as an interim decision. The quantum experts and the DAB are continuing to meet on various matters related to quantum principles, and good progress has been made. The remaining quantum matters in dispute have been narrowed down substantially. We remain confident that the DAB will be in a position to arrive at a final financial outcome. We expect that this final outcome will then be published by the DAB during the third quarter of 2024 as a final 20.4 decision in terms of the contract. On conclusion of the process, either party may issue a notice of dissatisfaction with the ruling and refer the dispute to arbitration. However, such ruling will remain enforceable unless and until overturned in arbitration. All contractor claims giving rise to entitlement for extension of time plus costs which occurred after December 2019 are considered to be Claim 6. There is an element of overlap between certain Claim 5 events, the effects of which have an impact on the critical path with respect to Claim 6's period. Therefore, Claim 6 will be dealt with once the Claim 5 entitlement has been resolved. The same quantum principles relating to Claim 5 will be applied to Claim 6. On final award from the DAB, the entitlements that will emanate from Claims 5 and 6 will then be recognized in the financial statements. Eskom Kusile Power Station, Stefanutti Stocks Izazi Package 28 Update. In June 2018, the JV instituted adjudication proceedings with respect to numerous compensation events which had not been assessed by the engineer. During February 2019, the contract was terminated by Eskom due to their inability to provide access to the JV for it to complete the works. In August 2019 and April 2020 respectively, the engineer issued 2 negative final payment certificates alleging overpayments. The alleged overpayments were for measured work and compensation events. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during November 2020 and February 2021. As several disputes relate to measurement of the works, the JV and Eskom have embarked on an independent quantum expert process to resolve these disputes. In order to accommodate this independent expert process, the parties agreed to stay the adjudication process and requested the adjudicator not to publish his decision. Remeasurement of the measured works is complete and a final value for work done has now been agreed. The group is confident that the final payment application is accurate and therefore no provision for overpayment has been made. Operational overview. One identified operation remains held for sale. Consequently, the results for this year and the comparative year have been prepared to reflect continuing and discontinued operations. The group's results have been restated due to the reclassification of the Highvec JV, a Mauritian company, which was originally part of the identified operation held for sale. The group continues to deliver satisfactory performance. The results were affected by restructuring costs, provision for an onerous contract, and the late award and contract startup of a major building contract in the coastal region. I shall now cover the key indicators for continuing operations. Contract revenue increased by 17% to 7.1 billion. The group's current order book is 8.4 billion, a 14% improvement against 7.4 billion for the prior year. The group's operating profit is 210 million, a 107% increase against the comparative year. Cash on hand improved by 194 million from 561 million to 755 million, this being a 35% improvement year on year. Yolanda will cover the other financial indicators later in the presentation. Included in the results are abnormal and non-operational items totaling 46 million. The Highvec JV was established to execute a contract awarded to the identified operation held for sale to construct villas for a resort in Mauritius. The JV has since been removed from the held for sale operation. The project was tendered on using out-of-country national labour. Due to changes in legislation and unnecessary bureaucracy, it took substantially longer to onboard the required out-of-country national labour, resulting in the JV being unable to achieve the accepted construction program. This is an industry-wide issue in Mauritius, resulting in the majority of contracts experiencing significant delays. Due to the late completion of the contract by the JV, the group has recognized an onerous contract provision, reporting a loss of 78 million. Normalized operating profit would have been 334 million at a 4.7% operating profit margin, a 95% improvement from the prior year. We will now review the financial performance of the group's 4 operational regions. Inland region delivered a strong performance with contract revenue and operating profit increasing to 3.1 billion and 194 million respectively. The civils discipline once again delivered an excellent performance, with all other disciplines performing to expectation. With respect to a contract mining project termination, a settlement agreement was reached, whereby the group has received 17 million to date, with a balance of 13 million expected to be received over the next 28 months. The arbitration matter relating to the cancellation of a petrochemical contract has been settled by the parties, and all claims for and against have been abandoned. The coastal region's contract revenue from operations is 1.2 billion, with an operating profit of 20 million. These results were negatively impacted by late contract awards and delayed commencement of projects. Western Cape's contract revenue is 1.1 billion, with an operating profit of 37 million. All disciplines performed to expectation. Africa region's contract revenue is 1.6 billion, with a reduced operating profit of 33 million. These results have been impacted by the Highback JV loss of 78 million. All other regions performed to expectation. With respect to the arbitration award relating to the Kalaba-Sikonga-Angola border gate road in the Western Province of Zambia, settlement discussions are ongoing and are on a without prejudice basis, and all legal rights remain reserved. Due to the uncertainty relating to the timing and quantum of receipts, the award has not been recognized in the financial statements. Inland's current order book is 3.2 billion, with short-term potential awards of 3.1 billion and future opportunities of 25 billion. Coastal's current order book is 2.1 billion. In the short term, there are potential awards of 600 million and future opportunities of 20 billion. Western Cape's current order book is 1.4 billion, with short-term potential awards of 1.7 billion and future opportunities of 23 billion. Africa's current order book is 1.7 billion. In the short term, there are potential awards of 1.6 billion and future opportunities of 30 billion. The group's current order book is 8.4 billion, with a short-term potential awards of 7 billion and future opportunities of 98 billion. Guidance for continuing operations for the next financial year. Inland region, we expect a slight increase in contract revenue with a reduction in operating margin to a more normalized level. Coastal region, we expect a significant increase in contract revenue and operating profit. Western Cape region, we expect an increase in both contract revenue and operating profit. Africa region, we expect an increase in contract revenue with a significant increase in operating profit. For head office, we expect similar costs as currently reported. I would now like to hand over to Yolanda.
Thank you, Russell. The group reports an increased turnover of 7.1 billion with an operating profit of 210 million. This represents an increase of 17% and 107% respectively. In line with the restructuring plan, the disposal of certain operations have been classified as discontinued operations. Going concern. The directors consider it appropriate that the group's results for the year be prepared on a going concern basis, taking the following into consideration. The current order book. Imminent project awards. Continuing operations executing the group's order book profitably. The availability of short, medium, and long-term projects. Reaching a favorable outcome on contractual claims and compensation events on the Kusile Power Project. continued support from the lenders, and successfully implementing the restructuring plan. The funding provided by the lenders has assisted with the group's liquidity, even though the group's current liabilities exceeds its current assets by 1,136 million, and the group's total liabilities exceeds its total assets by 52 million. The group believes it remains commercially solvent based on the cash flow projections included in the restructuring plan and the continued support of the lenders. However, the matters as noted above, including uncertainties surrounding the contingent liabilities, as stated in Note 26 of the group's consolidated annual financial statements for the year ended 28 February 2023, continue to indicate that a material uncertainty exists that may cast doubt on the group's ability to continue as a going concern, and as a consequence could impact on the group's ability to realize its assets and discharge its liabilities in the ordinary course of business. The group's net asset value improved from a negative 90 million to negative 52 million. The group executed contracts to the value of 41 billion since 2019. The lenders continue to provide guaranteed support for current and future projects. Restructuring plan update. The group on 27 March 2024 reached agreement with the lenders to extend the capital repayment profile of the loan as well as its duration to 30th of June 2025. With respect to the mechanical project termination arbitration award and the disposal of Altair Stocks LLC, a total of 106 million and 60 million respectively have been received from March 2023 to date. The final tranche of the purchase consideration, still to be collected relating to the disposal of Altair stocks, amounts to approximately 25 million. The lenders had initially provided the group with funding of 1.3 billion. Since inception of the restructuring plan, the group has repaid capital of 352 million, interest of 438 million, and incurred restructuring costs of 340 million, totaling 1.1 billion. The current outstanding capital balance is 984 million. The lenders continue to provide guarantee support for current and future projects being undertaken by the group. The group will continue to update shareholders on the progress of the various aspects of the restructuring plan. Looking at the statement of profit or loss. The statement of comprehensive income for the year ended 28 February 2023 has been restated due to a reclassification from discontinued to continuing operations of an entity known as the HIVAC JV, established in Mauritius to execute a specific project forming part of the Mozambique disposal transaction. Due to various commercial reasons, the parties now intend for the group's 80% shareholding in the HIVAC JV to be excluded from the disposal group. Due to legislative changes in Mauritius, it took the HIVAC JV substantially longer to onboard the required out-of-country national labour. As a consequence, the HIVAC JV is unable to achieve the construction program, resulting in the group recognising a loss of 78 million relating to this onerous contract. With respect to continuing operations, contract revenue increased by 17% to 7.1 billion, of which a total of 33% is generated cross-border. A 72% increase in EBITDA to 270 million, mainly due to an improvement in operating performance and reduction in restructuring costs. Continuing operations reported a significant increase in operating profit to 210 million compared to the 101 million of the prior year. Depreciation increased to 58 million due to the acquisition of plant during the year. Investment income increased to 44 million, mainly due to improved cash balances throughout the year. The prime lending rate has increased by approximately 4.5% over the past 2 years, resulting in an increase in finance cost to 134 million with respect to the funding loan compared to 115 million of the prior year. The tax charge is impacted by certain non-deductible expenditure as well as the profitability of the cross-border operations at their varying tax rates. Furthermore, the group has not provided for a deferred tax asset on the loss of 78 million reported for the HIVAC JV. Profit after tax for the year increased to 26 million compared to the loss of 37 million for the prior year. With respect to discontinued operations, the disposal group reported a loss of 10 million, comprising of a trading loss of 84 million, offset by the reversal of a fair value adjustment of 74 million. The Mozambique operation has been significantly impacted by the delayed start of contracts due to late awards resulting in holding costs. The profit for the year for total operations improved slightly to 16 million compared to the 15 million of the prior year. The statement of financial position. Plant and equipment of 117 million was purchased during the year, resulting in the increase of property, plant and equipment to 529 million. Of this capital expenditure, 67 million was financed through installment sale agreements. Non-current trade and other receivables consists of long-term trade receivables have reduced from 34 million to 7 million due to the raising of an expected credit loss provision of 23 million, as well as the reclassification of 27 million to current trade and other receivables for cash held as collateral for bank guarantees, resulting in a 3 million balance held as security for installment sale agreements. Even though trading activity increased, the days invested in contracts in progress as well as trade receivables reduced to 51 and 63 days respectively, compared to 56 and 78 days of the prior year. Other receivables increased from 667 million to 780 million, mainly due to the inclusion of the HIVAC JV. Non-current assets held for sale and disposal groups of 675 million predominantly comprises assets relating to the Mozambique operation. Liabilities associated with this disposal group amounts to 412 million. Shareholders approved the sale of the Mozambique operation on 22 November 2022 for a total purchase consideration of $13.5 million. To accommodate the exclusion of the HIVAC JV, the original transaction agreements will be amended without impacting on the purchase consideration. The transaction is anticipated to be completed within the next few months. Looking at the liability side of the statement of financial position, capital repayments of 226 million were made during the year, reducing total interest-bearing liabilities to 1.2 billion. Capex to the value of 67 million was financed through installment sales. The group envisages to service the funding loan from the proceeds relating to the disposal of the Mozambique operation and a favorable outcome on contractual claims and compensation events on the Kusile Power project. Trade and other payables decreased slightly despite the increased trading activities. Excess billings over work done is increased by 52 million to 1.3 billion, which includes 246 million pertaining to the HIVAC JV. Provisions increased from 649 million to 966 million, in line with the increase in trading activity, as well as the inclusion of the onerous contract provision of 48 million relating to the HIVAC JV. As mentioned earlier, liabilities associated with the Mozambique operation amounts to 412 million. Analyzing the statement of cash flows. The cash flow statement is presented for total operations. Operations generated 490 million compared to the 63 million for the prior year. In line with the increase in trading activities, as well as the unwinding of excess billings over work done, resulted in an investment in working capital of 168 million for the current year. Total tax paid mainly comprises of 32 million of foreign taxes relating to Eswatini and Zambia, and 42 million of withholding taxes, offset by a 12 million tax refund for the Botswana entity. Included within investing activities is capital expenditure of 37 million. Other investing activities mainly comprises of proceeds of 60 million relating to the Altair stocks disposal and proceeds of 43 million received for the disposal of property, plant and equipment. Financing activities reflect the reduction in total debt of 226 million as previously mentioned. The group's cash position has improved with 35% to 755 million from 561 million. In conclusion from my side, successfully implementing the restructuring plan and reaching a favourable outcome on contractual claims and compensation events on the Kusile Power project remain a priority. I will now hand back to Russell to close the presentation.
Thank you, Yolanda. I will now cover industry-related matters. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums throughout South Africa. There continues to be a lack of public sector infrastructure spend in South Africa. Should this improve, it will benefit the group. The regulations of the Employment Equity Amendment Bill were republished in February 2024 for public comment, following further submissions by social partners and stakeholders, including the construction sector. The regulations included amendments which will allow employers the opportunity to submit justifications for any failure to meet the ministerial targets for consideration by the Department of Employment and Labour. A broader definition of the targets to include all designated groups and restated targets to be achieved in a 5-year period, which still use the economically active population as a baseline for proportionality in target setting. It is anticipated that the bill and the regulations will be promulgated later this year. The risk remains that the targets will be set without meaningful consultation or supported by scientific data. In conclusion, our focus remains on successfully completing all outstanding items in our restructuring plan, achieving favourable outcomes from claims and compensation events on the Kusile Power project, and continuing our focus on maintaining and increasing profitability. This brings us to the end of our presentation. We are now available to field any questions. Thank you.